Welcome back, everybody. After selling my Hershey position that I talked about at length last week, I went ahead and added two new companies to my portfolio. Now, one is a company I've been analyzing for a couple months and is currently at a 40 price to earnings. And the other is another Magnificent 7 mega cap that's already doubled in 2023. So I know what you're thinking. What in the world am I doing? In this video, we're going to go over the two stocks that I added to my portfolio in detail, talk through the business fundamentals and valuation aspects that I liked, and break down what I'm monitoring for each one going forward. So let's get started with the first one, which is MSCI. MSCI Inc., which actually stands for Morgan Stanley Capital International, is a global investment solutions company, which I know probably means nothing to you. But what they do is a combination of a few different things. Index solutions, where they get licensing fees for equity indexes like the MSCI World Index and many others that are used by ETF providers and other clients. This makes up about 57% of their overall revenue. Analytics solutions, where they provide portfolio construction and risk management tools through data and software platforms. And this is about 24% of their total revenue. ESG data and research, which are products specifically around ESG data, and this makes up 11% of their revenue. Now, this is obviously a revenue stream that just on the surface, people can have a lot of polarizing opinions about, and I'll share with you mine here in a minute. And then lastly, they have a catch-all group called All Other Private Assets, which provides data and analytics for the other asset classes like real estate and other private assets. And so right off the bat, you're probably like, hey, MSCI sounds a little bit like S&P Global, and you would be correct about that. SPGI is one of MSCI's main competitors. And that being said, their business model is very attractive. They've shown consistent growth both in revenues and cash flow over the past decade. Their margins are excellent and just a bit below what I would consider the gold standard of margins, which is Visa and MasterCard, and MSCI is just a notch below that. When you look at their dividend growth, it's been just under 10 years, but they've averaged over 20% annual dividend growth over the past 9-year span, which is nice no matter how you look at it. And now, when you break down their revenues by type and not just category, you see that they have about 97% recurring revenue, which is great because it's more likely to be consistent and predictable over time. And lastly, if we take a look at MSCI's own projections, you can see that they expect double-digit revenue growth for the foreseeable future, as well as low to mid-teen adjusted earnings growth. Okay, so let's talk about some potential risks to their business. MSCI is heavily dependent on market activity growing or at least remaining high. And this is because a majority of their revenue comes from index licensing fees. So as market activity grows and ramps up, assets under management increase, their revenue grows with it. And if there's a reversal of that trend or market activity slows down due to economic reasons, they can be impacted. In general, though, passive investing continues to grow in popularity, which obviously bodes well for companies that create and maintain equity indexes. Now next, in terms of risks, MSCI as a leader in ESG data can be looked at as a positive or a negative, because these days, anything related to the term ESG is usually met with one of two responses. One, people love it, think it's great, and that we need more of it. Or two, people hate it and associate it with polarizing political issues. And for those of you that have watched this channel for a while, it's probably no surprise that my opinion on ESG data as it relates to stocks is somewhere in the middle. Because as an investor, I really have zero interest in it because I don't invest for personal causes or beliefs. I really am only investing to build wealth and make money. And in my opinion, ESG data really isn't a primary criteria that I think is a differentiator that indicates future success of a business. Now, for others who think differently or have a different investing style or believe that it is an indicator of future success, that's great. It's just not how I look at it. And it just so happens that MSCI is a global leader in providing that data. And you can see the popularity by the fact that it's the fastest growing segment out of their revenue streams. But I have it listed as a risk because anything that's polarizing or can be impacted by changes in political ideology or social narratives, to me, is a risk. Now, up to this point, it's been a positive for MSCI and their revenue growth, but we'll just have to see how it progresses. And then lastly, in terms of risks, MSCI trades at a relatively high valuation. Now, this is a premium we pay for them having slightly higher growth rates than their peers. The risk is that if those growth rates don't continue, then investors likely won't get the same level of returns that they're used to. And now, speaking of valuation, let's take a look at where MSCI is at. Now, at a 40 PE and a 36 price to cash flow, no one is going to mistake this for a value stock. But I do think relative to its growth prospects and margins, a higher multiple or premium makes sense. And that's not to say that I enjoy buying at a 36 price to cash flow, but I do think it warrants digging in a little deeper to understand what's going on. And one of the things I noticed is that MSCI has had a couple years of multiple compression. Back in 2021, they were trading at $650 a share at about an 80 PE and a 60 price to cash flow. And since then, their business has continued to grow by double digits and their stock price has come down. So both aspects of their price ratios have gotten more attractive, which has basically cut them in half. Now, just because it got cut in half from 80 to 40 doesn't necessarily mean that it's attractive at 40. It just means that it's gotten better. But this is definitely a business that has continued to grow and the price to value ratio has started to look more attractive. But if you look at the price metrics over a longer period of time, you can see that price to cash flow and even price to earnings are still higher than they were back in the pre-2020 years of MSCI's business. But as MSCI's revenue has grown over the past decade, the highest margin revenue, which is the equity index segment, has improved their overall margins. Their gross profit margin went from 72% to 82%, and their free cash flow margin went from 24% to 36% over that span. And so what I take from that is MSCI today is a higher margin business than it was pre-2020. So in theory, it deserves a slightly higher multiple. And plus, their own targets for the future are still at double-digit revenue and earnings growth. So all things considered, I felt that it was an acceptable price range to start adding it to my portfolio. But I only added a very small amount, about 2% of my portfolio to start, because I do recognize that this isn't the best possible price I could be buying at. And I'm going to continue adding to this position over time, especially if the price to value ratio continues to get better. And so just to recap my MSCI ad, does it fit my actual strategy? The answer is yes. It's outperformed the S&P 500, their wide moat business, they have cash flow growth, and their dividend growth is outpacing inflation, and in this case, by a lot. So in terms of my story for the stock, they're a global investment solutions company with revenue growing in the double digits. They have great margins at over 80% gross profit and over 35% free cash flow. Their revenue is over 95% recurring and grows as assets under management and passive investing trends grow. And they've only been paying a dividend for a little under 10 years, but their dividend growth has been on average over 20% a year. And in terms of what I'm monitoring for MSCI, are they hitting their revenue and earnings growth targets of low double digit and low to mid teens? Are their profit margins continuing to expand or at least outpacing their peers as their product mix evolves? Is their recurring revenue percentage still in the mid to high 90s? And is the ESG and climate segment still a positive differentiator, or is it a polarizing political risk? Okay, so let's get to the second company that I added to my portfolio last week, and that is Alphabet, or better known as Google. And I know, just like when I added Amazon, people are going to criticize this one too, because Google basically doubled in price in 2023, so why are you adding it now in 2024? And Google doesn't pay a dividend, so why are you adding it to a, quote, dividend growth portfolio? And as you guys have seen, I'll add a company to my portfolio when it doesn't meet every single one of my requirements, as long as the other aspects of the business are worth it to me. In this case, it just so happens that Google doesn't pay a dividend, at least for today. But as we saw with Meta this past quarter, that can change pretty quickly. Now, in terms of Google's business, obviously there's a lot to like. They are a dominant global technology company with market-leading platforms all over the place. Google Search, YouTube, Android, Chrome browser, Gmail, Google Docs and Workspace, and of course, they are a major player in the ultra-competitive cloud and AI discussion. And so we already have a pretty good idea of who Google is and what they do, so I'm not going to go over that too much in depth, but let's talk about some risks. Now, the main one that everyone's talking about and why Google seemed to dump over 3% last week is the idea that their bread and butter, which is Google Search and the ad revenue that comes from it, is going to be disrupted by AI, specifically OpenAI and their partnership with Microsoft. Combine that with Amazon having the fastest growing ad platform in big tech, and people are worried that Google's stranglehold on search on the internet is going to go away. And I have no idea exactly how that's going to play out, and obviously nobody really does. But I do know that Google is in a very strong position today. We're at a point where the term Googling is literally a verb that your grandma knows. So while more technical people may be able to make the switch over to something new, it's going to take a lot to move the general population, or at least a lot of time. Plus, that assumes that Google is just standing still and not innovating themselves, which we obviously know is not true. Because Google is one of the most knowledgeable and experienced AI companies in the world. and they make $100 billion in operating cash a year that they can put towards whatever they need to. And that's in addition to the 40 plus billion a year they spend on R&D already. But they are in extremely competitive industries against top competition that will decide their level of ongoing success. Obviously, cloud is a huge part of that, with Amazon and Microsoft having more market share than Google does right now. AI is another area, both with developing AI-related tools for their clients, but also realizing product and feature gains for their existing market share-leading products. And second, one of Google's big risks is their overall lack of efficiency. They've been criticized probably the most out of the big tech firms in terms of growing large with bloated costs. Their stock-based compensation is really high, and there's quite a bit of opportunity for Google to get more efficient than they are today. Now, will they do that? I mean, at this point, we don't really know, but I do think it's one of their biggest opportunities of where they can get better, and also one of their biggest risks if they decide to just stay the same. And to me, it's one of the reasons why they haven't matched the performance of their big tech peers over the last decade. But again, this is a company that's generating $100 billion in operating cash every year. So if they can make just reasonable progress in this area, it can have a very large positive impact. And then lastly, in terms of risks, Google is dealing with regulatory and labor issues like most of their big tech counterparts. They've had multiple incidents with upset employee leaks and walkouts, and as layoffs have happened, those have ramped up again. And this is somewhat related to the cost risk from above, because if you're also dealing with employee satisfaction issues, then it becomes another consideration that you're dealing with as you figure out how to cut costs. On the regulatory front, there's things like the EU Digital Markets Act and the US Justice Department that's going after Google for things like paying to be the default option for search on iPhone and other devices, and many more. And it's tough to know how these are going to turn out, especially when Google lost their case against Epic Games late last year. But at this point, it's just something that I'll need to keep watching. And that's part of the challenge with companies like Google. Like, they're so dominant that it makes them very interesting as investments, but it also makes them targets to people who think that they have too much power. But in addition to their attractive business, I also thought the company was attractively valued, even after almost doubling over the past year. And I first noticed this when I was researching Amazon and I was looking at adjusted PE ratios based on R&D spend, with Google being in the same group as Amazon and Meta as looking the most attractively priced. And of course, we already know what's been happening with Meta, which many of you have asked me about in the comments and over email. But I talked about Google's valuation in my most recent newsletter as well. Now let me show you two companies and tell me which one is more interesting to you. Now, of course, you can't just look at stats and numbers and really understand a stock, but looking at these two, I think if we're being honest, stock B has slightly better value metrics than stock A. But stock A has significantly better revenue and free cash flow growth prospects than stock B. So which stock would you consider the best value for your money? And now, in case you're wondering, stock B is Hershey and stock A is Alphabet or Google. Now, what's the actual point of showing this? If you ask people right now which stock was overvalued or undervalued, what do you think that they would say? You'd probably hear something like, well, Hershey's down 30%, so it's definitely undervalued right now. Or Google has almost doubled over this past year, so it's definitely overvalued right now. But looking at these numbers, do you still feel the same way? Now, there's some caveats, of course. This price to cash flow number is just operational cash flow, so it doesn't count for CapEx and stock-based compensation. And if you adjust for those, then Hershey's going to look much better because those are areas where Google spends a lot. But the relative growth profiles are pretty different too, in favor of Google, obviously. And Google spends a ridiculous amount on R&D versus Hershey, so if you view that as shareholder value, etc., like all these things that we've talked about before. It just depends on how you choose to value companies when you research them. But the point is, as investors, we always talk about value, but when you hear people's opinions, it's almost always based only on the price, which really doesn't make sense. So when I saw that these two companies were pretty close together as it relates to value metrics, I was a little bit surprised. And that's why, even with the risks, I feel pretty good about Google at these levels, and that's why I added it now. I decided to add 100 shares of Google, which makes it about 5% of my total portfolio. So to recap my Google ad, does it fit my overall strategy? Technically, no. Now, it's outperformed the S&P 500. It definitely has a wide moat. They're definitely growing cash flow. But in terms of dividend growth, obviously, Google doesn't pay a dividend. Now, for me, the story for Google is they're a globally dominant technology company with a diverse set of market-leading platforms. They're dominant in search, mobile, email, user-generated video content, and browsers. They're a top contender in cloud services and AI. They have regulatory and antitrust concerns like pretty much all of big tech does right now. They have labor and stock-based compensation and really just overall cost-related concerns, and they're in extremely competitive spaces that threaten their core revenue streams. And lastly, they generate $100 billion in operating cash per year. And I've said that multiple times because it's just a really large number that I think presents a lot of opportunity for what they can do with it. In terms of what I'm monitoring for Google going forward, I'm looking at their overall revenue growth story and if it's continuing to look good, their percentage of revenues for search versus their other segments like YouTube and cloud, their overall trend in market share for cloud, mobile, and productivity, which is Docs, their overall cost and how they're managing it, including stock-based compensation, and then their regulatory, antitrust, and labor issue updates. So what do you guys think about MSCI and Google? Are you holding either one of these stocks? Let me know down in the comments below. Now, if you guys are just getting started buying individual stocks and you want to know what the hardest part of the process is, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.